If you're like many homeowners right now, you're stuck in a home your family's outgrown or that no longer fits your lifestyle, simply because sky-high interest rates make upgrading feel impossible. Maybe it's a starter condo you grabbed a few years ago, planning to flip it into something bigger soon, or perhaps you're eyeing a spot with space for ADUs to rent out, or house the in-laws for family support. What if I told you there's a way to make that move up by, lock in a low rate without today's market mercy, and that your situation might be primed for it? And no, I'm not pushing temporary rate buy downs that tease temporary low payments for a bit before spiking. This strategy especially shines for veterans and active duty. I'll explain why soon, but civilians can tap in too. And real quick, if you're new to the channel, my name is Bratt, and I'm a real estate broker in Southern California. My team and I serve San Diego and Southwest Riverside counties, and we've helped over 100 people buy, sell, and invest in real estate. If you're looking to do the same, feel free to reach out. My contact info is listed below. And if you haven't already, go ahead and subscribe so you don't miss out on future content on topics like this and more. You've likely been holding pat, dodging move-ups because jumping from a 2 to 3% mortgage up to a 6 to 7% simply craters affordability. On the same balance, payments balloon 50% higher at 6.25% versus 2.75%. If you factor in principal pay down over 10 years, it's a brutal 69% more costly. And that's why sales volumes are scraping pre-2008 lows, with thousands of homeowners frozen in place. A common take right now? Rates trap you. Sit tight or suffer sticker shock. But here's a contrarian hack. Look specifically at homes with assumable loans to inherit ultra-low rates. Proof? In San Diego, hundreds of listings have them. Rates in the 2s, 3s, or even 4s that crush today's 6 to 7%. I was just speaking with a client with $200,000 equity from a 2019 condo buy who was eyeing a significantly larger detached home with an assumable VA loan. The equity gap between the purchase price and the sales price was just $100,000, and with a rate even lower than theirs from 2020. Leaving them with not only enough to cover the gap with cash, but to also pocket cash for savings, another investment, or even to put towards building an accessory dwelling unit in the back. Today we'll break it down. Why now is the time prime for this? How to pull it off with veterans having extra leverage here, and key downsides in a bonus financing tool. First up, your strongest play. Leverage equity from your low rate to bridge assumable gaps. To give some context, most assumable loan products, which include not only VA loans but FHA and USDA alike, have balances below purchase price. But if you bought your home 3 or more years ago, your current equity will go a long way towards covering it in many of these homes, and sometimes with a surplus. And here's how we do it. We list your current home contingent on securing the upgrade. This way, if we can't find a suitable replacement property that makes a ton of sense for you, you simply don't sell. If and when we do find that no-brainer move-up deal that would significantly improve your lifestyle or achieve some other goal, you make up the gap in cash from your sale. No new high-rate loan needed. In my client's case, selling the condo, assuming the VA loan on the bigger house in a better neighborhood, and then rolling the equity from their condo into the better property. In this way, you stay invested, upgrade your lifestyle, and keep payments sane. This flips the rate trap. Move now in a slower market before rates drop and prices surge. In the big picture, if and when rates rise, even if only into the 5s, this will likely spark increased buyer competition. This strategy allows you to grab assumables in a buyer-friendly market while inventory sits at 5-year highs. That equity bridge is game-changing, but veterans have an advantage here that might be the difference between an accepted offer for an assumption versus a rejection. And here's why. As a veteran or active military, you can substitute your VA entitlement, freeing up the seller's VA loan for their next buy with no strings attached. Because technically, VA loans are assumable by anyone, but non-vets tie up the seller's VA entitlement until they refi or sell, meaning they won't be able to buy their next home with 0 down if their loan is assumed by a civilian. This gives you more negotiating power as a vet, and sellers will prioritize you over those who can't replace entitlement. For civilians to have a shot, they might have to sweeten their offer with a higher price or other incentive. That is, if the sellers will even entertain a non-vet assumption. In sluggish markets like right now, this leverage nets better deals, and combined with equity from your sale, it allows you to unlock moves others can't. And another reason VA loans are particularly advantaged here is because in markets like San Diego, Oceanside, and other areas around the US within an hour of military bases, military homeowners are often moving more often than civilians, equating to a higher number of VA assumable products compared with FHA or USDA. Additionally, if the property is vacant or the deadline is looming, these sellers will often be more amenable to considering offers subject to assumption. Now, if equity is short, or even if you're a first-time veteran buyer, this play is still an option for you when you blend it with a second loan. For example, there are loan programs we can connect you with that offer second position loans up to 90% combined loan to value ratio, or CLTV, at market rates, But when you look at the blended rate, you can still save big. And here's how that would work. You'd buy the property and assume the low rate balance and finance the gap up to 90% less than the total sales price for the remaining portion. As an example, let's say you want to buy a property listed for $700,000 with a $500,000 assumable loan at 3%. If you were to take out a second $100,000 mortgage at 7.5%, you'd be looking at an effective blended rate of 3.75%, which is still a whole lot better than a new mortgage at 7% for the whole thing. With this tool in your back pocket, it allows you to be flexible for bigger gaps and keeps you moving without full cash outlay. Now, downsides to watch here. Not every home qualifies or seller agrees. And again, this is only for properties with existing FHA, VA, and USDA loans. Many sellers with these loans won't even consider an offer subject to assumption. Now, downsides to watch. Not every home qualifies or seller agrees. And again, this is only for properties with existing VA, FHA, or USDA loans, and many sellers with these loans won't even consider an offer subject to assumption. Also, timelines stretch from 30 days on the low end to 90 days versus the more common quick close, which is often around 21 to 30 days. Additionally, there are some fees to be aware of, such as the 0.5% VA funding fee for VA loans, a $300 processing fee, but generally the assumption sales don't require appraisals, which also saves some cash. Also, there are some services that help facilitate the process to make everything flow more smoothly and even offering shortened processing times. And these can be up to 1% of the sales amount, but these don't apply to every transaction. So wrapping up, we've offered a solution to that rate lock paralysis. Assume a low rate now, sell your home contingent on the assumption, and use your equity to bridge the gap and stay invested in the market. All while making a smart upgrade before any significant rate cut causes the market to heat up. And veterans, your edge seals it for VA loan assumptions. For civilians, you still have a shot, but you'll be able to compete with the best of them with FHA and USDA assumptions. And here's a bonus tip. To be taken seriously when submitting an assumption offer, you'll want to have your ducks in a row. If you have a house to sell, this means already having it on the market or at least having it ready to go and having a pre-approval on hand from a reputable lender to show you definitively qualify for the loan, even though it's going to be an assumption. And if you need a lender contact or are considering a move-up purchase, selling a property, or even buying your first investment property to build ADUs on, let's chat. Shoot me a text, email, or call. My contact info is listed below. We'll crunch the numbers and even see if assumables are a fit for you. If you found any of this helpful, share it with friends who might also benefit. Thanks for watching, and I'll see you in the next video.